I want you to think about your grandfather for a second. Not the guy you see at holidays, but the version of him in the late 1970s. He's maybe 35 years old, working a steady job in Cincinnati or Pittsburgh or Detroit. He's watching the news. Gas prices are exploding. Grocery bills are climbing. His paycheck isn't keeping up. And all the while, the guys on TV, the economists, the bank executives, the government officials, are telling him the fundamentals are solid. Don't panic, things are fine. The economy is resilient. 6 months later, the United States entered one of the worst recessions in modern history. He wasn't warned. He wasn't prepared. He just watched it happen to him. Now, fast forward to right now, mid-2026. Meet Daniel. He's 38, lives in Columbus, Ohio, works in mid-level project management at a logistics company. He makes $74,000 a year. On paper, things look okay. He hasn't been laid off, his 401k is still there, the stock market is near record highs, but Daniel is feeling something in his gut that doesn't match what the financial headlines are telling him. His grocery bill is $340 a month, up from $210 2 years ago. His credit card balance has crept up to $9,400 because every time something unexpected happens, a car repair, a medical bill, a spike in his energy costs, there's nothing in savings to absorb it. He got one raise in 3 years. His company quietly eliminated the open position above him rather than promote him. He works alongside a team that's leaner than it was 18 months ago. And when he goes online and reads that the economy is resilient and consumer spending remains stable, it feels like a cruel joke. Daniel isn't imagining things, and the data is finally starting to back him up out loud. A March 2026 NerdWallet survey found that 65% of American consumers, nearly 2/3 of the entire country, expect a recession to hit within the next 12 months. That number jumped 6 percentage points in just 1 month. Meanwhile, Bankrate's Q1 2026 survey of top economists found that professional forecasters now put the odds of a U.S. recession in the next 12 months at more than 1 in 3. And here's the part the banks and financial media are being extremely careful how loudly they say. Recession odds for 2027 on prediction market platform Kalshi currently sit at 41%. While just weeks earlier, recession odds for 2026 were as high as 36.9% before temporarily cooling down. Consumer spending, which drives more than 2/3 of all U.S. economic growth, rose just 0.1% in April 2026. The personal savings rate dropped from 3.6% in March to 2.6% in April, meaning Americans are burning through their cushion. The labor market created just 116,000 jobs for all of 2025 and lost 92,000 in February alone. And credit card delinquencies have risen to their highest levels since 2012. These numbers aren't coming from doom and gloom blogs. They're coming from the New York Fed, the Conference Board, Stanford University, and CNBC. What's happening in the economy right now is real. And most everyday Americans have no idea how to protect themselves when it arrives. That's what today's video is about.
What's up, everyone? Welcome back to Andrew Finance, the channel where we cut through the financial noise and tell you what's actually happening with the economy in plain English with real numbers behind it. If you're new here, hit that subscribe button right now because we put out content every week that most financial media is too careful to say out loud. And if you've been with us a while, drop a comment below. Does the economy feel fine to you right now, or does something feel off? I want to know. Let's get into it. So let's talk about what the actual warning signals are saying right now, because there's a crucial difference between what Wall Street wants you to believe and what the underlying economic data is actually showing. And those two things are telling very different stories in mid-2026. The first signal is the Conference Board Leading Economic Index, which is one of the most respected and closely watched recession prediction tools in the world. The LEI tracks 10 forward-looking economic components simultaneously, from building permits to manufacturing orders to consumer expectations. As of mid-2026, the LEI's 12-month growth rate is still in negative territory, even after 2 small monthly increases. The Conference Board itself noted that consumer expectations remain a major drag on the index. This is the part that matters. When consumer expectations are falling, it means people are already pulling back emotionally before they pull back financially. That pullback becomes a self-fulfilling prophecy fast. The second signal is the ISM Manufacturing PMI, which has been sitting below the contraction threshold of 50 for an extended stretch. Manufacturing weakness is one of the earliest leading indicators of broader economic trouble. It shows up in real order flows and inventory numbers long before it hits the job market headlines. The average American small business is now paying more in debt service than at any point since 2007, as companies that refinanced pandemic-era debt at rock-bottom rates of 1 to 2% are now rolling those loans over at 5 to 6%. That's an enormous shift in the cash flow picture of millions of businesses, and when small businesses feel that squeeze, hiring freezes and then layoffs follow. The third signal is what Stanford University's Economic Policy Research Institute is calling a stagflation-light environment. The Federal Reserve is stuck between a rock and a hard place. Inflation is still running above its 2% target. Cutting interest rates too aggressively risks reigniting that inflation, but keeping rates elevated risks tipping an already slowing economy into recession. That's the trap. And as CNBC reported in March 2026, Fed Chair Powell himself acknowledged that the path through is increasingly narrow. When the Federal Reserve Chairman uses language like that, it's worth listening carefully. The fourth signal is the yield curve pattern. The 10-year versus 2-year Treasury spread inverted in 2022, stayed inverted for nearly 2 years, the longest inversion since 1978, and then normalized. Historically, recessions don't typically arrive during yield curve inversions. They arrive after the curve normalizes, as the Fed begins cutting rates in response to weakening conditions. The normalization that happened in late 2025 fits that exact historical pattern.
Now here's where it gets genuinely interesting, and honestly, a little frustrating, because what the biggest banks in America are saying publicly and what they're actually doing with their money and their lending practices are two very different things, and that gap tells you everything you need to know about how seriously the people with the most information are taking this moment. The first thing banks are doing is tightening their lending standards quietly. When you see language in Federal Reserve's senior loan officer surveys about banks tightening credit standards and increasing collateral requirements, that's not a neutral administrative adjustment. That's banks quietly pulling back from risk because they're preparing for a rising wave of defaults. Tighter lending means fewer business loans, fewer personal loans approved, higher bars for credit, which flows directly into slower investment, slower hiring, and slower growth across the entire economy. The second thing banks are doing is building up their loan loss reserves, which are essentially internal rainy day funds that banks are legally required to maintain in proportion to the loans they expect may default. When major banks increase their loan loss reserves, they are explicitly pricing in the expectation that more borrowers are going to stop paying. They're not broadcasting this loudly, but the data is in their quarterly filings for anyone who looks. The third thing is the most telling of all, and it connects directly to Daniel's experience in Columbus. Credit card delinquency rates have now climbed to their highest point since 2012, according to 2026 data. Banks know this because they own those delinquent accounts. And while the headline press releases talk about resilient consumer spending, their internal risk teams are watching a consumer who is increasingly relying on debt to maintain a lifestyle that their income can no longer fully support. Consumer spending, as measured by personal consumption expenditures, rose just 0.1% in April 2026. The savings rate dropped to 2.6%. That's not a resilient consumer. That's a consumer who's running out of road. Here's the psychology piece that makes all of this so dangerous for everyday people. Behavioral economists call it normalcy bias, the tendency to assume that because something hasn't catastrophically collapsed yet, it won't.
The stock market near all-time highs, the unemployment rate still technically low, no single day where everything visibly breaks, so most people do nothing, because doing nothing feels safe because nothing has explicitly gone wrong yet. But recessions don't announce themselves. The 2008 financial crisis didn't announce itself in 2006. The 2001 dot-com crash didn't announce itself in 1999. The signals appeared in the data months before the event, just like they're appearing now, and the people who were watching the signals rather than the headlines had time to prepare. Daniel in Columbus doesn't need to predict the exact date of a recession. He doesn't need to be an economist. He just needs to stop assuming that because things feel okay right now, they'll stay that way without him doing anything, and start making the moves that insulate him from whatever comes next, whether it arrives in late 2026 or 2027.
Okay, so let's talk about what you actually do right now, because none of this information matters unless it translates into real, concrete actions you can take this week to put yourself in a stronger position before a recession arrives. And let me be very clear about something first. Preparation is not panic. Building financial resilience right now is smart, regardless of whether a recession hits in 6 months or 2 years, because the moves that protect you in a downturn are also just good financial habits in any environment. The first and urgent move is to build or rebuild your emergency fund. The standard advice is 3 to 6 months of expenses. In a recession environment where job losses and income disruptions can last 12 to 18 months, 6 months should be your floor, not your ceiling. If you're currently carrying a savings rate anywhere near the national average of 2.6%, that is not a cushion. That is a cliff edge. One unexpected job loss, one medical event, one major car repair from that position, and you are immediately in debt survival mode instead of weathering the storm mode. The second move is to aggressively pay down high-interest debt right now while you still have stable income. This is the thing most people put off, and it is the exact thing that becomes catastrophic during a downturn. In a recession, income gets disrupted. Layoffs, reduced hours, lost side income. The monthly debt payments don't pause. Credit card debt at 22%, 24%, 26% interest doesn't care about your unemployment rate. If you eliminate those obligations now, your monthly break-even number drops dramatically, meaning you can survive on a smaller income for a longer period without going under. The third move is to audit your job security honestly, not optimistically. Look at your industry, your company's recent behavior, hiring freezes, quiet reorganizations, project cancellations. History shows that layoffs in a recession tend to follow predictable industry patterns. Manufacturing, retail, real estate, finance, and media typically see the first waves. If you're in a vulnerable sector, now is the time to update your resume, refresh your professional network, and potentially start developing a second income stream before you need it urgently. The fourth move is to avoid making panic-driven investment decisions. A certified financial planner cited in a June 2026 U.S. News report put it simply and correctly. The stock market usually drops months before a recession starts and begins its recovery well before a recession ends. The worst move is often sitting on the sidelines because the biggest market gains typically occur while the economic news is still terrible. Don't sell everything. Don't go to cash. Don't try to time the market. Review your asset allocation and make sure it's appropriate for your age and timeline, but stay invested because the people who panic out always miss the recovery. As for Daniel from Columbus, he started by building a $6,000 emergency fund over 4 months, paid off his highest interest credit card, and picked up a weekend freelance project management consulting gig. He's not predicting the recession, he's just making sure it can't knock him out if it comes. You can do the same. That's it for today's video. If this gave you something real to think about, hit the like button and share this video with someone you know who needs to hear it before it's too late to prepare. Subscribe to Andrew Finance if you haven't already, because we've got more videos coming that cut through the noise and give you the real financial picture.
Drop a comment below and tell me, does the economy feel stable to you right now, or are you feeling what Daniel was feeling? I read every single comment. See you in the next one. Stay sharp, stay building.